A retired engineer in Columbus, Ohio passed away in 2022. He had spent 31 years building a traditional IRA worth $420,000. He named his 2 adult children as equal beneficiaries. He thought he was leaving them a life-changing gift, $210,000 each, tax-deferred, growing quietly until they needed it. His daughter called her accountant 3 months after probate closed. She wanted to know how long she could leave the money in the account. The accountant's answer changed everything. Under a law called the Secure Act, signed in 2019, she had exactly 10 years to withdraw every single dollar from that inherited IRA. 10 years. After that, the IRS would treat the entire remaining balance as ordinary taxable income in a single calendar year. She did not panic. 10 years felt like a long time. She figured she would take a little each year. Then her accountant explained the second part, the part almost nobody mentions. For certain beneficiaries, the IRS does not just require you to empty the account in 10 years. It requires annual minimum distributions during that window. Miss one, and the penalty is 25% of the amount you fail to withdraw. On a $210,000 account, missing a single required distribution could cost $15,000 or more in penalties alone. She had already missed the first distribution deadline. Nobody told her. The bank where her father held the account sent her a letter about the inheritance. Nobody at the bank mentioned the annual distribution requirement. Nobody at the county probate court mentioned it. The IRS certainly did not send a welcome letter explaining the new rules. That woman is not unusual. That is what happens when a retiree passes away with a traditional IRA, and their children have never heard of the Secure Act, the 10-year rule, or the annual distribution requirement that comes with it. If you have a traditional IRA or a 401k, and you plan to leave it to your children, there are 5 things you need to do right now before you die that could save your family tens of thousands of dollars and prevent a tax disaster they will never see coming. This video is for educational purposes only and is not tax or financial advice. Consult a qualified professional before making any decisions about your specific situation. My name is Frank Retires. Every day I break down the tax rules, the financial traps, and the strategies that protect retirees from the things nobody else is explaining. If that sounds like something you need, hit the subscribe button right now and turn on notifications so you never miss a video. Here is what changed and why your children are now walking into a tax trap you built by accident. Before the Secure Act, a non-spouse beneficiary who inherited a traditional IRA could stretch required minimum distributions over their entire lifetime. A 50-year-old who inherited an IRA could take small distributions for 30 or 40 years, keeping most of the money growing tax-deferred and spreading the tax hit across decades. That strategy was called the Stretch IRA, and it was one of the most powerful intergenerational wealth tools in the entire tax code. The Secure Act eliminated it for most beneficiaries starting January 1st, 2020. Now, most non-spouse beneficiaries, which means your adult children, your siblings, your nieces and nephews, must empty the inherited IRA within 10 years of the original owner's death. Every dollar, taxed as ordinary income in the year it is withdrawn. Here's what makes it worse. In 2022, the IRS clarified that for certain beneficiaries, the 10-year rule is not just a deadline. It comes with annual required minimum distributions in years 1 through 9. If the original account owner had already started taking their own RMDs before death, the beneficiary must continue taking annual distributions based on their own life expectancy factor, and then drain the account completely by the end of year 10. There are 3 groups at risk. Adult children who inherit a large traditional IRA and do not know about the annual distribution requirement. Younger beneficiaries in high-earning years who are forced to take large taxable withdrawals on top of their employment income. And retirees who named an adult child as beneficiary 15 years ago and have never updated that designation. 5 steps protect your family from all 3 problems. Step 1, know your beneficiary designation and review it this year. Your IRA beneficiary designation is the most important document you have never looked at twice. It overrides your will. It overrides your trust. If your IRA beneficiary form says your adult son inherits the entire account, your will means nothing. The IRA goes to your son regardless of what else you wrote down. Here is what wealthy people do when they open a retirement account. Their attorney reviews the beneficiary designation the same day the account is opened, and every 3 to 5 years after that. It is not optional on their checklist. It is just done. For most retirees, the beneficiary form was filled out at an HR orientation in 1996 and has never been touched since. Here is what wealthy people do when they open a retirement account. Their attorney reviews the beneficiary designation the same day the account is opened, and every 3 to 5 years after that. It is not optional on their checklist. It is just done. For most retirees, the beneficiary form was filled out at an HR orientation in 1996 and has never been touched since. The most dangerous outdated designations involve ex-spouses, deceased beneficiaries, minor children listed without a trust in place, and estates. If your estate is listed as the beneficiary of your IRA, your family loses all distribution flexibility, and the account typically must be fully distributed within 5 years with no annual distribution structure at all. Call your IRA custodian this week. Ask them to send you a copy of your current beneficiary designation, verify every name, then call a financial advisor or estate planning attorney and confirm it makes sense for your current situation. Step 2. Understand the 10-year rule and which of your beneficiaries it applies to. Not every beneficiary is subject to the 10-year rule. The IRS created a category called eligible designated beneficiaries who are still allowed to stretch distributions over their lifetime. This group includes your surviving spouse, a minor child of the account owner, and that means minor, not adult, a disabled or chronically ill beneficiary, and a beneficiary who is not more than 10 years younger than you. Your adult children do not qualify. Your siblings who are more than 10 years younger than you do not qualify. Your grandchildren do not qualify. For the vast majority of retirees who plan to leave a traditional IRA to their adult children, the 10-year rule applies in full. Here's where it gets critical. If you die after your required beginning date for RMDs, which under the Secure 2.0 Act is April 1st of the year after you turn 73, your adult child beneficiaries must take annual distributions in years 1 through 9 based on their own life expectancy factor from the IRS Single Life Expectancy Table. Then they must drain the account completely by the end of year 10, miss a single annual distribution, and the penalty is 25% of the amount that should have been withdrawn. Under Secure 2.0, that drops to 10% if corrected within 2 years. But that is still a massive penalty on money that was going to be taxed anyway. Let me put real numbers on this. You die at age 79 with a traditional IRA worth $350,000. Your 53-year-old daughter is the sole beneficiary. Based on her age in the IRS Single Life Expectancy Table, her distribution factor in year 1 is approximately 31.1. Her first required distribution is $350,000 divided by 31.1, roughly $11,250. She must take that by December 31st of the year following your death. She has never heard of this requirement. The bank did not tell her. She does not take it. The penalty is 25% of $11,250, nearly $2,800, for missing one distribution on an account she did not know had a distribution requirement. And if she misses it a second year, the penalty compounds again. Step 3. Convert traditional IRA money to a Roth now before you die. Here is the single most powerful thing you can do to protect your children from the inherited IRA tax trap. Convert your traditional IRA to a Roth before you pass away. A Roth IRA has no required minimum distributions during your lifetime. The money grows tax-free. And when your children inherit it, the 10-year rule still applies. But every distribution is tax-free, not deferred. Free. Let me show you what that difference means in real dollars. Your child inherits a traditional IRA worth $400,000. Over 10 years, the account grows while they take distributions. If they withdraw roughly $55,000 a year at a combined federal and state tax rate of 25%, their total tax bill over 10 years could approach $100,000. Now take the same child inheriting a Roth IRA worth $400,000, same 10 years, same growth, their tax bill on every distribution is zero. The reason most retirees do not do this is that a Roth conversion requires paying income tax on the amount you convert in the year you convert it. A $200,000 conversion could generate a federal tax bill of $30,000 to $50,000 depending on your bracket. But here is what changes that calculation entirely. If your IRA balance is lower today than it was a year ago because of market volatility, you can convert a greater percentage of the account at a lower tax cost, and all of the recovery happens inside the Roth, completely tax-free. A $50,000 Roth conversion in a down market that then recovers 20% means $60,000 growing tax-free inside the Roth, while you only paid tax on $50,000. At a 22% bracket, that market timing saved you $2,200 on a single conversion. Over a decade of annual conversions, that adds up to tens of thousands. The ideal window for Roth conversions is between retirement and age 73, before RMDs begin, when your income and tax bracket are often at their lowest. Talk to a tax advisor this week about how much you can convert annually without crossing into the next bracket. Now, before I get to step 4, I need to talk about something the original version of this advice always leaves out: the IRS. If you die with a federal tax lien against your estate, that lien does not disappear. Federal tax liens follow assets. Your beneficiaries could inherit an IRA that the IRS has already placed a claim on. A federal tax lien is filed when you owe back taxes and do not respond to collection notices after the IRS sends a bill. Once it is filed, it attaches to everything you own, including your retirement accounts. For retirees, this happens more often than you think. You miss an estimated tax payment, you do a Roth conversion, and do not account for the tax. You receive a large Social Security lump sum payment that pushes you into a higher bracket and do not adjust your withholding. The IRS sends a bill, you put the letter in a drawer, 6 months later, there is a lien on your estate. In 2025, the IRS issued over 760,000 levies, bank accounts, wages, and Social Security benefits, and federal tax liens were filed against hundreds of thousands of properties and accounts. Retirees on fixed incomes are disproportionately affected because they often do not have the cash flow to pay an unexpected tax bill quickly. Stay current on your taxes. Open every letter from the IRS. If you owe money, set up an installment agreement immediately. An installment agreement stops the IRS from escalating as long as you are making payments. Your children should not inherit a tax lien along with an IRA. Get ahead of it now. Step 4. Name a trust as beneficiary only if it qualifies under current IRS rules, and verify it does. Many retirees have been told to name their revocable living trust as the IRA beneficiary. This sounds protective. The trust controls the distributions. It can include provisions for minor grandchildren. It can shield an inheritance from a beneficiary's creditors or a divorce proceeding. But here is the critical trap. If the trust is not structured correctly, specifically as what the IRS calls a see-through trust or a conduit trust, the IRA may not qualify for the 10-year rule at all. It could instead be required to distribute the entire balance within 5 years with no annual flexibility whatsoever. That is a worse outcome than simply naming your children directly. The IRS has very specific requirements for a trust to qualify as a designated beneficiary. The trust must be valid under state law. It must be irrevocable or become irrevocable at the owner's death. All beneficiaries must be identifiable individuals, and documentation must be provided to the IRA custodian by October 31st of the year following the account owner's death. If you have a trust named as your IRA beneficiary, ask your estate planning attorney this week to confirm it qualifies under Post-Secure Act rules. The law changed in 2020. Many trusts were drafted years before that change and have never been reviewed. Do not assume that the trust your attorney set up in 2015 still works the same way under the current rules. One phone call. That is all it takes to find out whether the document sitting in your drawer is protecting your family or creating a problem for them. Step 5. Talk to your beneficiaries now before you die about what they are inheriting. This is the step that requires the least paperwork and saves the most money, and almost nobody does it. Your children are going to inherit your IRA. They are going to receive a letter from the custodian. They are going to call the bank and ask what to do next. And the bank is going to explain how to transfer the funds into an inherited IRA. The bank is not going to explain the 10-year rule. The bank is not going to tell them which years require annual distributions. The bank is not going to warn them that waiting until year 10 to take everything at once could push them into the highest tax bracket of their lives. Have the conversation now. Walk them through the 10-year rule. Tell them that the first required distribution deadline is December 31st of the year following your death, not whenever they feel ready, not when the estate fully settles, not when it is convenient. A specific deadline, a specific penalty for missing it. If your estate has multiple accounts, walk your children through which are Roth and which are traditional, because the tax treatment is completely different. A beneficiary who treats a Roth inherited IRA the same way as a traditional one, or who neglects the distribution requirement entirely, is leaving tax-free money sitting in an account the IRS will eventually force out in the worst possible year at the worst possible rate. Wealthy families handle this with a family meeting and a binder. It is not optional on their checklist. For most retirees, nobody ever tells them to have this conversation until it is too late to have it. Let me bring it all together. Here is your checklist. 5 steps. One afternoon. 1. Call your IRA custodian this week and request a copy of your current beneficiary designation, verify every name, update any outdated designations immediately, especially if an ex-spouse, deceased individual, or your estate is listed. 2. Confirm whether your beneficiaries are subject to the 10-year rule. If you plan to leave a traditional IRA to adult children, assume the 10-year rule applies and that annual distributions will be required starting the year after your death. 3. Talk to a tax advisor about Roth conversions during your gap years, the window between retirement and age 73, when your income and tax bracket are typically at their lowest. Converting now means tax-free distributions for your children later. 4. If you have a trust named as your IRA beneficiary, ask your estate planning attorney to confirm it qualifies as a see-through trust under Post-Secure Act IRS rules. If it was drafted before 2020, it may need to be updated. The retiree who does these 5 things leaves their children an inheritance. The retiree who does nothing leaves their children a tax bill, a deadline they have never heard of, and a penalty letter from the IRS that arrives before the estate is even settled. The difference is not money, it is the checklist. 5. Have the conversation with your beneficiaries now. Walk them through the 10-year rule, the annual distribution requirement, and the December 31st deadline. This conversation costs nothing and could save your family tens of thousands of dollars. This is Frank Retires. If this video helped you, hit the like button right now. It takes 1 second, and it helps this video reach more retirees who need to hear it. If you are not subscribed yet, hit subscribe and turn on the bell so you do not miss the next one. If you know a retiree who has a traditional IRA and adult children listed as beneficiaries, send them this video today, not tomorrow. Today. Drop a comment. Have you reviewed your IRA beneficiary designation in the last 5 years? I read every single one, and the most common situations become future videos. I will see you in the next one.